John Taft, CEO of RBC Wealth Management in the United States. Thanks for being with us here today.
My pleasure.
So we heard from the report, the wealth report that you guys have just put out. It said that 2 million more high net worth individuals are now in the system than there were pre-crisis. So I'm wondering, does this suggest that high net worth individuals are better off than they were before, or what?
Well, absolutely. Okay. What has happened since the financial crisis, and by the way, we went from about 10 million high net worth investors globally down to 8.5 million post the financial crisis, and from those levels we have rebounded to 12 million high net worth investors globally, and there have been two drivers of that. Number one is the rebound in global financial markets, so investable assets of all kinds have appreciated in value since the financial crisis. But secondly, there's been enormous amounts of wealth generated by entrepreneurs and business enterprises in Latin America and in Asia and in emerging economies, and that is powering the growth of ultra high net worth investors. Asia Pacific, not surprisingly, is the #1 growth engine in terms of number of high net worth investors. The United States, or North America, actually recaptured the top ranking in terms of numbers this year, but looking forward, we think Asia Pacific is going to be the driver.
And in terms of allocation of assets for these high net worth individuals, the report showed that the highest allocation is actually in cash. Can you tell us a little bit about why that is?
Yeah, this was one of the top and most striking and pronounced findings in the study that drove the report, which, by the way, is the most extensive research study of high net worth behaviors and attitudes ever conducted. Over 4,400 high net worth investors participated in the survey in 21 different countries. But what they told
directly instead of their advisors, is
yeah,
that right?
directly to the researchers. And what the study shows is that two things. First of all, in terms of asset allocation, almost 30% of high net worth investor assets are allocated to cash and or deposits. And don't forget, this is at a time when the yield, nominal yield on those assets is 0 and the real yield is negative. So it shows you just how cautious these investors are. And then when we ask them what investment objectives they have, fully a third say that preservation of capital is their top investment objective, as opposed to growth for only a quarter of the investors who were surveyed.
Mm-hmm. So why do you think that they're still mostly allocated to cash as opposed to equities in real estate?
Well, two things. First of all, I think this preference for preservation and for safe asset classes, if not cash and deposits, then short-term, high-quality fixed income. That is a function of the fact that a lot of the wealth you see in the high net worth space comes from entrepreneurs, owners of businesses who are engaged day to day in risky assets. And so when they take money out of those businesses, they want to make sure that the money they've earned is preserved over time. So there's always a higher allocation to cash in the high net worth category than in other investor groups who are relying, those other investor groups, on growth to help them realize their financial goals. Not true in the upper end. But there is also no question that there is a lingering effect across all investor categories, and the high net worth category is the same, of distrust in the markets and caution post-financial crisis. These were investors, like everyone, who were traumatized by what happened, and we haven't recovered yet.
So let's look back to the preservation versus growth perspectives of these high net worth individuals. You said more people are suggesting that they would like to preserve their wealth as opposed to try and grow their wealth. Maybe that loops into what we were just talking about. Can you explain a little bit more why that is?
Well, in terms of preservation of capital, what investors are telling us is that they want to have a sure source of capital to protect them against adverse developments in their operating businesses. They want to have a source of capital to leave to their heirs. That's very important to high net worth investors. And they want to have a source of capital to create a legacy, in whatever area is important to them. So the idea that a high net worth individual needs to generate a 5+% annual rate of return in order to achieve those objectives simply isn't the case. All they need to do is have the capital they're investing keep its value over time. It's a completely different investment challenge than applies to investors who, as I say, are relying on growth in order to achieve their retirement needs or their legacy needs.
So if you were to compare now versus, you faced regulations throughout your years in this business. Why is now different than any other time?
Well, spike in regulatory activity post the financial crisis. A lot of things that the regulators saw that they didn't like in terms of the way wealth management firms were behaving, and a lot of regulations being put on the books to make sure that never happens again. That's why now versus not before. But you're right, there's always been business as usual regulatory activity, and that's still going on, by the way, in addition to the financial reforms specifically spiked by the financial crisis.
Sure. Now, final point, I know this is not something that the report covered, but non-high net worth individuals, your average investors, what can they take away from this report? What should it be telling them?
Well, high net worth investors generally are facing one of the most challenging investment environments of our lifetimes. Don't forget, most of the investors who have wealth today, just sheer numbers, are moving towards entering or moving through retirement. Okay, so they have moved from an investment challenge that's all about accumulating wealth to an investment challenge that's all about living as long, having their money last for as long as they live. It's a deaccumulation challenge, it's an income challenge. Well, in the world today, cash yields 0, short-term fixed income yields 2% or less, and yields on high-quality dividend stocks are in the 2 to 3% range, and equities, while they've appreciated recently from the base of the financial crisis, still have had very modest real returns over the last 10 years. So where does an investor who's accumulated a pile of money look to invest so that they don't outlive their money? That is the single most important financial challenge most investors face today. That's very different from the challenge, as we talked about earlier, that ultra high net worth investors are facing. So really to say that the rich are different is sort of true. The rich are different. These are people who are more interested in preserving their wealth than in growing their wealth, and that differentiates the focus of this report from the vast majority of investors.
So you're saying that it might be difficult for the non-high net worth individual to kind of draw some parallels between themselves and
yeah, I think it would be a mistake to follow the investment strategy of ultra high net worth individuals. There's simply no way you can invest a third of your portfolio in cash and achieve your investment goals. So I think this report speaks to different issues.
Well, John Taft, CEO of RBC Wealth Management US, thanks so much for being with us.
You're welcome. It's my pleasure.